So we will discuss the multiple choice problems for chapter 20, the first chapter on shareholders equity. Okay, so the question here is what amount should be reported as total contributed capital. So at this point, it's important for us to know what will constitute or comprise your total contributed capital. So basically, your total contributed capital class would be the portion of your shareholders equity that will come from shareholders. Because if you if you have gone over the various shareholders equity accounts, uh, basically you can split them into two: those coming from the investments of your shareholders, and those coming from the profits of the entity, those forming part of your retained earnings. Okay, so the part of our shareholders equity that is paid for or being given by the shareholders will be considered as part of your contributed capital. But simply stated, class, your contributed capital will be your share capital, your share premium, and your subscriptions, class. Okay, so your total contributed capital will be composed of your share capital, the par value of your shares, the share premium, the excess of the price of the shares over their par value, which is understandable because after all, the reason you have share premium is because the shareholders more than paid for the shares in an amount greater than its par value. Okay, and you would also be including your subscriptions capital even though the shares are not yet fully paid and were not yet issued. Okay, so just remember share capital, share premium, and subscribed capital. Okay, so on January 1, 2022, Negros Company was incorporated with the following authorized capitalization. Okay, total value authorized ordinary share capital would be 20 million, preference share capital 10 million. During the current year, the entity issued 150,000 ordinary shares for a total of 18 million and 50,000 preference shares at 60 per share. So that would be 50,000 times 60. That would give you 3 million. So from these issuances alone, we know that these two will form part of our contributed capital, so we will have 18 million and 3 million. In addition, on December 15, 2022, subscriptions for 20,000 preference shares were received at 100 pesos per share. The subscribed preference shares were paid for on January 15, 2023. Okay, so we will be including your subscriptions class since they are going to be collected within 12 months. So they can be part of our uh, capital already. So the value of your subscriptions here would be 20,000 times 100. You would get 2 million. Okay, so 18 million from your ordinary shares, both par value and excess over par, and then you have your preference shares of 3 million, and then you have your subscribed capital for 2 million. So the answer here would be 23 million. That's 18 million plus 3 million plus 2 million. Let's proceed to problem 20-11. What amount should be reported as share premium at year end? So at this point, it's important for you to know what goes to your share premium. So any issuances in excess over the par value will go to your share premium. At the beginning of the current year, a share company was organized with authorized share capital of 100,000 shares of 200 peso par value. During the current year, the entity had the following transactions affecting shareholders' equity. January 10 issued 25,000 shares at 220 a share. So from this transaction, we know that there is an excess of 20. Okay, and we issued 25,000 shares. This issuance will increase our share premium in the amount of 500,000. That's 25,000 times 20. Okay, while your share capital will increase by uh, 25,000 times 200 will increase by 5 million. Okay, but we are only asked how much will be reported as share premium. Okay, so this is the first year of the entity, and we issued shares above par, 25,000 shares above par, uh, in the price of 220. So there's an excess of 20 per share. Okay, but the question is at year end, so we will have to consider the other two transactions. On March 25, issued 1,000 shares for legal services when the fair value was 240 a share. Supposedly, if you issue shares in exchange for services, the issuance of the shares should be recorded at the fair value of the exchange service or goods. Okay, but here we are not given with that information, so we will have to use the fair value of the shares. Okay, so the entry will be debit expenses and credit share capital and share premium. The amount that will be credited to share capital would be the par value of these 1,000 shares, so that would be 200,000, and then the credit to share premium would be the excess. Okay, the fair value exceeds the par value by 40. So there will be share premium of 40 per share. So 40 times 1,000, you will have 40,000. Last transaction, September 30, issued 5,000 shares for a tract of land with the fair value was 260 a share. Again, the solution for this problem would be different if we were given with the fair value of the shares. But since we are not given, we will have to use the fair value of the I mean, the solution would have been different if you were given the fair value of the land. But since we are not, we will have to use the fair value of the shares. So 5,000 times 260, or simply just get the excess over the par value of 60 per share. 60 times 5,000, you would get 300. So from the January transaction, there's an excess, or we will be recognizing share premium on January in the amount of 500. For the March transaction, we will be recognizing additional share premium in the amount of 40. For the September transaction, we will have additional share premium in the amount of 300,000. You add those three, you would get 840,000. Next, problem 20-12. We have two questions here. What amount of the proceeds should be allocated to the ordinary shares? What amount should be reported for share premium on the issuance of the ordinary shares? Okay. At the beginning of the current year, Cove Company, a closely held entity, issued 6% bonds with a maturity value of 6 million, together with 10,000 ordinary shares of 50 par value for a combined cash amount of 11 million. If issued separately, the bonds would have sold for 4 million on an 8% yield to maturity. So basically, we have issued two kinds of instruments: a debt instrument, the bond, and your equity instrument, which is your shares. Okay, but they were sold for a basket price. You have a single price for these two instruments. Okay, the question now is, how do we allocate? So this is an important theory for you to remember. If you're given the basket price to be allocated between liability and equity class, you give the full fair value of the liability, and the excess will go to your uh, the excess would go to your equity. Okay, we that's a way of applying the residual interest concept. Okay, we will not be allocating them by using fractions based on their separate fair values. Instead, from the basket price, you give you take the entire fair value you take from the basket price the entire fair value of the equity of the debt instrument, of the liability of the bond, and the excess will be allocated to the equity instrument. Whatever is left after allocating the entire fair value of the debt component, that the excess would simply be the amount that will be given to the equity instrument, no matter how small. You give 100% of the fair value of the debt component, and whatever is left would be allocated to the equity instrument. Okay, so think of it as a priority class. Your debt component will be given full priority. Okay, so the basket price was 11 million. Okay, so we will not be using fractions to allocate this 11 million. We know that the bond component, if it was sold separately, would have a value of 4 million. So we will treat this as the fair value of the bond. So out of 11 million, we take the entire 4 million. So the bond would be recognized at 4 million, and the remaining amount would be allocated for the equity. So in this case, the amount that will be allocated to the value that will be allocated to the equity instrument to the ordinary shares would be 7 million. Okay, so 11 million, you take entire 4 million and you are left with 7 million. So the answer number one here for problem 20-12 would be Bravo. Okay, and knowing that the value that will be assigned to these shares would be 7 million, we would now be able to know how much then will go to the share premium, because we know that we are issuing 10,000 shares, and the 10,000 shares are to be valued at 7 million after splitting the 11 million between the debt instrument and the equity instrument. Since the par value of the shares is 50 per share and we issued 10,000, uh, you will have a share capital in the amount of 500,000. And since the total value that is assigned to the shares, to the ordinary shares, is 7 million, that means the excess over the par would be 6,500,000, and the entire 6,500,000 would be credited to your share premium. So the answer to the second question in problem 20-12 would be 6,500,000. Okay, that's 7 million minus the par value of the 10,000 shares issued in this transaction. A very important theory class. If you are given with a basket price for a debt instrument and equity instrument, the fair value of the debt instrument would be fully allocated, and the excess it is just the excess that would be allocated to the equity instrument. Okay. Proceeding to problem 20-13, Remington Company issued 10,000 ordinary shares with 200 par value and 20,000 preference shares with 200 par value for a total consideration of 8 million. At the date of issue, the ordinary shares was selling for 360 and the preference shares was selling for 270. Okay. So very important to distinguish problem 20-13 and problem 20-12. First, how are these two problems similar? In this problem, you are given with a basket price. You are given with a single price for more than one items. Okay. But in problem 20-12 class, the basket price is for a debt instrument and an equity instrument. Whereas in problem 20-13, the basket price is for both equity instruments. Since they are both equity instruments, no special treatment is given to either of them. Unlike in problem 20-12, we gave a special treatment to the debt instrument and we just gave the residual to the equity instrument. Since here in problem 20-13, they are both equity instruments, they will be treated the same. So the allocation of the 8 million price, the 8 million basket price, would be based on their fair value. Okay, but that's another thing you have to remember. If you're given the basket price for both equity for two kinds of equity instrument, then they will have to be allocated based on their fair values. Okay. The problem is for some students, they would think that the fraction would be simply based on the individual fair value. What do I mean? The fair value of one preference share is 270, while the fair value of one ordinary share is 360. Okay, that's the price they are selling for. Okay, some would use these two amounts to get the fraction to allocate the 8 million. Okay, you assign 270 to the preference shares, you assign 360 to the ordinary shares, you add the two, you would get 630, and 630 would be the denominator to allocate to uh, to proportionately distribute the 8 million. So your fractions here would be 270 over 630 for the preference shares and 360 over 630 for your ordinary shares. But that is not correct. Okay, so the idea is correct that you are allocating them based on their fair values, but you should be using fair value, their total fair values, because the size of the issuance class, the number of shares issued for the preference share and the ordinary shares will matter. Okay, so you do not just use the price per share, you get the total fair value of all the shares that are being issued. Since you are issuing 20,000 preference shares, the valuation that should be given to them should be uh, should be should take into account that there will be 20,000 preference shares, and on the other hand there would also be 10,000 ordinary shares. Okay, so if you allocate it only based on 27360, you are ignoring the fact that you are issuing more preference shares than ordinary shares, and logically a bigger portion of the price should go to the uh, preference shares, considering that you are issuing more preference shares. So the way to do it is to get the total fair value and not the per share. Okay. So 20,000 times 270. So 20,000 times 270, you would get, I think that's 5,400,000. Let me just check. 270 times 20. So the total fair value of your preference shares that are being issued would be 5,400,000, while the total fair value of your ordinary shares would be 3,600,000. That's 10,000 ordinary shares times 360 pesos price per share. Okay, so the total fair value of the ordinary shares is 3,600,000, and the total fair value of your preference shares is 5,400,000. If you add those two, you would get 9 million, and the 9 million would be our divisor uh, allocating in apportioning the 8 million. So to get the value that will be assigned to the preference shares, you multiply the 8 million with the 5,400,000 total fair value of the preference shares divided by 9 million, the total fair value of the preference and ordinary shares. Now for the ordinary shares, you multiply the same 8 million by 3,600,000 this time, the fair value of the ordinary shares, divided by 9 million, the combined fair value of the ordinary and preference shares. Okay, and if you do that, 5,400,000 divided by 9 million, that's 60%. And 60% of 8 million would be 4,800,000. Okay, but why is that not in the choices? Because the question asks for the share premium. The 4,800,000 is the value that will go to your preference shares. Okay, but since we are asked for the share premium, we would have to determine how much then is the par value of the preference shares. Here, the par value of the preference shares is 200. Okay, so out of the 4,800,000, how much will go to share capital and how much then would go to share premium? If we are issuing 20,000 preference shares and each has a par value of 200, the total par value would be 4 million. So out of the 4,800,000 value assigned to it, 4 million will go to your share capital, the par value. So that means the amount that will be credited to share premium would be 800,000, and the answer there would be Charlie. Okay, and we'll have to do the same for the ordinary shares. How much of the 8 million is allocated to the ordinary shares? It was 3,200,000. Okay, but the 3,200,000 would go to the share capital and share premium. Okay, and as discussed before, the amount that goes into your share capital accounts would be the par value, and anything in excess of the par value will go to your share premium. Okay, so if the total value that will be allocated to the ordinary shares is 3,200,000, how much then goes to the share capital account and how much goes to your share premium? Okay, and to answer that, we need the par value of the ordinary shares. And it so happens that the par value is also 200. So you multiply the 200 with the 10,000 ordinary shares we issued. There should be credit to our ordinary share capital in the amount of 2 million. But since the value allocated to the ordinary shares issued is 3,200,000, that means the extra 1,200,000 goes to the share premium, and that's why the answer to the second question is 1,200,000. Okay, so it's both letter C, 800,000 share premium preference shares, 1,200,000 share premium ordinary shares. Okay, so remember, if again problem 20-12 and 20-13 deals with issuance of financial instruments for a basket price. 20-12, debt and equity. 20-13, two kinds of equity instruments. Okay, let's proceed to problem 20-14. Questions here: what amount should be reported as shareholders' equity on December 31, 2022? And what amount should be reported as shareholders' equity on December 31, 2023? So what's happening in this problem? On January 1, 2022, Pen Company began operations by issuing at 15 per share one half of the 950,000 ordinary shares of 10 par value that had been authorized for sale. In addition, the entity had 5,000 authorized preference shares of 5 per value. During 2022, the entity had 1,025,000 of net income and declared 230,000 of dividend. So from this paragraph class, we will be able to answer the December 31, 2022. We begin with the January 1. This would give us the initial amounts for the shareholders' equity accounts. Okay, what did we do on January 1, 2022? We issued one half of our authorized shares. Okay, and how many authorized shares did we have? 950. And did we issue the entire 950? No, we only issued half. And how much is one half of 950? That's 475. And then at what price were they issued? They were issued at uh, 15. So you multiply the 475,000 shares by 15. Okay. Ordinarily, we should be segregating the amount that will go to the share capital and the share premium. Okay. The total issue price is 7,125,000, and supposedly we should be determining the amount that will go to share capital and share premium. But since the question in the problem class is the total, there's no need to distinguish because both the share capital and share premium will form part of your uh, total shareholders' equity. Okay, so we begin with 7,125,000 since this is the value of the shares that we have issued. Then in addition, the entity had 500,000 authorized preference shares of 5 par value. Okay, this is just telling us of the existence of these shares. It does not tell us that we have issued these preference shares. Okay, so please don't make the mistake of including this in your answer for uh, uh, 2022. Okay. Okay, but another transaction here for 2022 is that the entity had 1,025,000 of net income and declared 230,000 pesos of dividend. Will this affect shareholders' equity? Yes, because if you have net income, it will go to your retained earnings. And if you also declare dividends, it will also be a deduction to your retained earnings. And of course, your retained earnings is a component of your shareholders' equity. Okay, so your 7,125,000, you add here your net income of 1,025,000, and you deduct the dividends you have declared in the amount of 230. Okay, and our answer here would be 7,920,000. And then question number 22, number 2 is for 2023. So we'll just have to take into account the transactions that happened during 2023. Okay, so the ending balance on December 31, 2022 is 7,920,000. And it's important for us to remember because the ending for last year would be the beginning for the current year. So the 7,922 will serve as the beginning balance of the shareholders' equity for 2023. So please take note of the 7,920. Now, what happened during 2023? Okay, we begin with 7,920. Then we issued 100 ordinary shares for 17. Okay, so you multiply 100,000 by 17, that will give you 1,700,000. Okay, you add this with your 7,920. Okay, then issued 150,000 preference shares for 8 per share. That would give you 1,200,000. So you add 1,200,000 also. Authorize the purchase of a custom-made machine to be delivered in January 2024. The entity restricted 300,000 of retained earnings for the purchase of the machine. Okay, so although we have not discussed it in this chapter, when you restrict a portion of your retained earnings, you will be taking that away from the unappropriated retained earnings and transfer it to your appropriated retained earnings. But that will not affect total retained earnings. And as a result, that will also not affect total shareholders' equity. So you are just reclassifying these 300,000, but it still remains in your retained earnings. So this transaction does not have any effect on your total shareholders' equity. It would have been different if uh, you would be asked how much is the total unappropriated retained earnings, because this would have been relevant. But since the question is how much is the total shareholders' equity, this is just a transfer within your shareholders' equity accounts. Okay, so this will not affect total shareholders' equity. Okay, what else happened? Issued additional 50,000 preference shares for 9 per share. So that would be 450,000. So you add 450,000 from the amounts we have added earlier. And then we also reported income. So again, income will increase retained earnings, therefore it will also increase shareholders' equity. So you also add the 1,215,000. Okay. But since we also declared dividends in the amount of 635, this would also affect your retained earnings. This will be a deduction to your retained earnings, so deduct this 635. Okay, and we would get 11,850,000. That would be our answer for question number 2. Okay, so uh, very important thing to remember here is that you have to know when you should be deducting the dividends. Okay, so here the dividends were declared in 2023 on December 31, 2023, but uh, it was to be paid on February 1, 2024. So should the dividend already affect our 2023 shareholders equity even though it is to be paid in 2024? The answer is yes, because dividends are to be recorded on the date they are declared, not on the date of the payment. The date of the payment will only affect the payable account. Okay. Again, under accrual, your liability for the dividends arises the moment they are declared. So you will have to recognize the dividends the moment they are declared. It does not matter that they are to be paid in 2024, since they are declared in 2023, then they will have to be recorded in 2023. It would have been different class if the date of declaration was in 2024. We would not have deducted the 635 for our 2023 we would not have deducted it for our 2023 balance uh, if it was declared in 2024. Okay, but it is relevant in our computation for 2023 because it was declared in 2023. Okay, so again, the answer here is 7,920,000 and 11,850,000. Next problem. Orlando Company issued 8,000 convertible preference shares with 100 par value at 100 per share. One preference share can be converted into 3 ordinary shares with 25 par value at the option of the shareholder. Subsequently, all the preference shares were converted into ordinary shares. The market value of the ordinary share at the date of conversion was 30. What amount should be credited to share premium as a result of the issuance of the preference shares and the subsequent conversion into ordinary shares? Okay, so we have convertible preference shares here, which were issued at 105, which is above its par value. So there will be a share premium here. So 8,000 times 5. The 5 is the excess of the issue price over the par value. So 8,000 times 5, you would have 40,000. The one preference share can be converted into 3 ordinary shares with 25 par value at the option of the shareholder. Then all of the preference shares would be were converted into ordinary shares. The market value of the ordinary shares on the date of the conversion was 30. Okay, so how many ordinary shares? It can be converted into 3. So how many convertible preference shares did we issue? 8,000. And they can be converted into 3 ordinary shares. So that means if all the 8,000 preference shares were converted, then we will have to issue 24,000 ordinary shares. Okay, and how how did we get 24,000? That's 8,000 preference shares times 3, because again, each preference share can be converted into 3 ordinary shares. And the moment they are converted, class, the accounts related to them should be derecognized. Okay, so when they were issued, we will have to multiply the 8,000 with their issue price. That's 8,000 times 105. So the total value of the preference shares is 840,000. 800,000 goes to the share capital account. 40,000 goes to your share premium. Okay, and since they will be converted into ordinary shares, we will be needing 24,000 ordinary shares, and their par value is 25. So 24,000 times 25, that would give you uh, 600,000. Okay. So basically, the preference shares will be changed into ordinary shares. How much was the value of these preference shares? Total of 840, 800 share capital, and 40,000 share premium. If they are converted, the entire 840 should be removed. So we will have to debit your preference share capital, 800,000, and debit your preference share premium preference shares in the amount of 40, and everything will go to the ordinary shares. Okay, but the credit there upon conversion would be to the ordinary share capital account and to the share premium ordinary shares. Because again, the rule is the amount that will enter your share capital account should only be the par value. Okay, so how much was the value of the uh, preference shares that were converted? 840. So these 840 will be transferred now to your ordinary shares accounts, to the share capital and to the share premium account. Okay, but the amount that should go to the share capital should only be the par value. And how much is the par value of the resulting 24,000 shares? 600. But how much was the total value of the preference shares before they were converted? 840. So there is an extra of 240,000. And where will this 240,000 go? This will go to the share premium ordinary shares. So the answer here would be 240,000. So the complete entry for the conversion class would be debit preference share capital 800,000, debit share premium preference shares 40,000, and credit ordinary share capital 600,000, and credit share premium ordinary shares 240,000. Okay. Very important, if they are to be converted, full derecognition. Remove the share capital account, also remove the share premium related to them. Next, problem 20-16. Uh, During the current year, Hyatt Company issued for 110,000 per share, 15,000 convertible preference shares of 100 par value. One preference share may be converted into 3 ordinary shares with 25 par value at the option of the preference shareholder. All of the preference shares were converted into ordinary shares at year end. The market value of the ordinary share, the conversion date was 40. What amount should be credited to ordinary share capital as a result of the conversion? So basically the same problem in problem 20-15, but different questions. Okay, how much was the total value of these preference shares? They were issued for 110 each, multiplied by 15,000 shares. That would be 110 times 15. Okay, a total value of 1,650,000. Okay, and then they can be converted into 3. So since we know that all will be converted into ordinary shares, we know that as a result, we will be issuing total of 45,000 ordinary shares. Okay, remember the total value of the preference shares was 1,650,000. Okay, and then we will, upon conversion, we will have to transfer this 1,650,000 to ordinary shares accounts, to your share capital and to your share premium. Okay, so we will be issuing 45,000 shares, which has a par value of 25 each. So 45. Let me just try to recall how much was the total value. 15 times 110. That's 1,650,000. Okay, so 25 times 45, you will have 1,125,000. So that's the par value of the 45,000 shares that we'll be issuing. And understandably, that would be the amount that will be credited to ordinary share capital upon conversion. So that would be the answer in number 1. Next, what would be the share premium? So whatever is the excess from the total value of the preference shares that were converted, it was 1,650,000, and we know that 1,125,000 will go to your share capital account. So that means the amount that will go to your share premium would be 525,000. So the answer number 1 here is 1,125,000, while the answer to number 2 is 525,000. Okay, so just remember, the total value of the convertible shares should be transferred to your ordinary uh, share capital accounts. Okay, but possible source of error here would be on students forgetting that the amount that will enter your ordinary share capital account or whatever kind of share, as long as it's the share capital account, it should only be the par value. So what if there was only one question here? How much would be credited to ordinary share capital? Possible wrong answer here would be 1,650,000. They will transfer everything to the ordinary share capital account. But again, that is wrong, because the amount that will go to your ordinary share capital account should only be the par value of the shares that are issued. Okay, and for you to get that, you should be able to solve the 45,000. Okay, and where did we get the 45,000 shares? We have the 15,000 convertible preference shares multiplied by 3, because each convertible preference share can be converted into 3 ordinary shares. Okay. The discussion for the other multiple choice problems in the other chapters will come in a separate video.